Here's the honest reality. That era is over.
In 2022, something happened that most investors had never seen before in their lifetimes. Stocks and bonds dropped at the same time and dropped hard. The stock market fell roughly 19%. What stunned a lot of people was that long-term bonds fell even further, closer to 30%. The asset class that was supposed to cushion the blow made things worse. The culprit was inflation. When inflation runs hot, the Fed raises interest rates. When rates rise, existing bond prices fall. A bond paying 2% suddenly looks a lot less attractive when new bonds are paying 5%, so the value of what you're holding drops. Most people don't realize that the 40-year tailwind that made bonds so reliable, steadily falling rates, is simply not there anymore. We're in a different environment now. Higher government debt, inflation that hasn't fully gone away, and interest rates that aren't heading back to zero anytime soon. Real talk. This doesn't mean bonds have no place in your portfolio. It means expecting them to behave the way they did in 2005 or 2012 is probably not a safe assumption anymore.
Before we talk about what to put in your portfolio, let's talk about the single most practical thing you can do to protect yourself from sequence of returns risk in this environment. It's called a root reserve, and it's simpler than it sounds. Set aside 5 years of living expenses in stable, liquid assets. Cash, money market funds, short-term CDs. Not stocks, not long-term bonds. Money you can actually reach without selling anything. If markets drop, you live on the reserve. You give your portfolio time to recover before you're forced to touch it. The average bear market lasts about 2.5 years. 5 years of reserves means you can wait it out without locking in losses. At this stage of life, that buffer isn't a nice to have. It's the foundation that makes every other strategy work.